Every market crash in history has made long-term investors richer, not despite the crash, because of it. I know that sounds backwards. We're trained to fear crashes. The news goes crazy. Your portfolio turns red, your stomach drops, and your brain screams at you to sell everything before it gets worse. But here's what I've learned after 10 years of investing. The wealthy don't run from crashes. They run towards them. And once you understand why, you'll never look at a market downturn the same way again. I first really understood this from J.L. Collins and his stock series. And once you see the math behind it, you can't unsee it. It changes everything. So let me show you why crashes are actually the engine that drives wealth. We're taught from day one that market crashes are disasters, something to avoid, something to fear. The financial news treats every downturn like the apocalypse. Experts come on TV looking grave, warning about how this time could be different. And yeah, crashes feel terrible when you're in the middle of one. I'm not going to pretend otherwise, but here's what nobody shows you. If you pull up a chart of the stock market from 1900 to today, over 120 years of data, you'll see something that should completely rewire how you think about this. The Great Depression, it's there. You can see it. Black Monday in 1987, when the market dropped 25% in a single day, visible. The dot-com crash, the 2008 financial crisis, COVID in 2020, all of them are right there on the chart. And you know what else you see? The line only goes one direction over time, up. Every single one of those crashes, those world-ending, panic-inducing, this time is different crashes, they all look like temporary blips when you zoom out far enough. The Great Depression, which people thought would end capitalism itself, is just the dip on that line that keeps climbing. But here's the part that nobody explains. Why does it always recover? It's not magic. It's not blind optimism. There's an actual mechanism at work here. And once you understand it, crashes stop being scary and start looking like opportunities. To get there, we need to look at what the market actually is. Think about professional sports leagues for a second. The best leagues have a system. Teams that perform poorly get relegated or lose their spot. Teams that perform well rise up. The league is constantly refreshing itself with better and better competition. The stock market works exactly the same way, except it happens automatically and in real time. When you buy a total market index fund, something like VTI or VTSAX, you're not picking individual stocks. You're buying a piece of roughly 3,600 different companies all at once. Big ones, small ones, tech companies, banks, retailers, manufacturers, the whole economy. Now picture all those companies arranged on a bell curve. On the left side, you've got your worst performers, the struggling companies, the ones that might not make it. On the right side, you've got your winners, the companies that are crushing it, growing and dominating the industry. And here's the math that changes everything. What's the worst thing a bad company can do to your investment? It can lose 100% of its value. That's the floor. It goes to zero. It disappears from the index and it gets replaced by a new company that's growing. But what's the best thing that a winning company can do? There's no ceiling. A stock can go up 100%, 500%, 1,000%, 10,000%. There's literally no limit. Think about this for a second. Apple started as a small computer company operating out of a garage. If you held it from the early days, you'd be looking at returns of over 100,000%. Amazon went from an online bookstore that Wall Street marked to one of the most valuable companies on the planet. Nvidia went from a niche graphic cards maker to powering the entire AI revolution. Meanwhile, what happened to Blockbuster, Kodak, Enron? They went to zero, completely wiped out. But that's the point. They can only lose 100% and then they're gone. Cleared out of the index, replaced by something new and growing. The index doesn't hold on to losers out of loyalty. It doesn't get emotional. It just updates. Constantly, the dead weight falls off and new growth takes its place. This is why the market always goes up. It's not hope. It's not faith in the economy. It's math. The upside is unlimited while the downside is capped and self-removing. The market is constantly cleaning out the losers and making room for the winners. So during a crash, what's actually happening? A crash isn't the market failing. It's the market doing its job faster than usual. Think of crashes as the market's cleaning crew working overtime. Weak companies that were barely hanging on, they get cleared out. And here's the cool part. When those struggling companies shrink or disappear from the index, your money automatically shifts towards the companies that are still standing. The index rebalances itself. You don't have to do anything. I'll be honest, it took me a while to actually feel this way. When I see my portfolio drop 20%, 30%, my first instinct is still that knot in my stomach, that voice saying, do something. But now I try to see it differently. When the market is red, that's the self-cleansing mechanism in action. The market is taking out the trash. And as an index fund investor, I don't have to do anything. The index automatically removes failing companies and adds rising ones. Here's where it gets even better for anyone who's still buying. Let's say you're investing $500 a month into an index fund. During normal times, that $500 might buy you 5 shares. But when the market crashes 40%, that same $500 suddenly buys you 8 or 9 shares. You're buying more ownership of the economy at a discount. And when, not if, when the market recovers, all those extra shares you bought on sale multiply right along with everything else. The person who kept buying during the crash ends up way ahead of the person who stopped or sold. Let me make this concrete. If you invested $500 a month from 2007 through 2009, right through the worst financial crisis since the Great Depression, you'd have accumulated shares at prices that looked terrifying at the time. But those shares, they've multiplied several times over since then. The people who kept buying during those dark days are now sitting on gains that the people who panicked and sold will never see. The math works, the self-cleansing mechanism works, the system works. But here's what most people, including me at various points, have completely messed this up. Everything I just told you is easy to understand when the market is going up. When your portfolio is green and growing, it's easy to say, oh yeah, crashes are opportunities. I'll definitely keep buying. But when you're actually in a crash, when you've watched your life savings drop 30% in a month, when the news is screaming about recession and you're worried about your job, that's a completely different story. I remember sitting there during a particularly rough stretch, watching the numbers fall day after day. And I knew that the right move was to do nothing, or better yet, buy more. The math was on my side. History was on my side. But my brain was screaming something else entirely. Sell now before you lose everything. This time is different. Get out while you still can. The gap between knowing and doing might be the most expensive gap in all of investing. Here's something that should scare you. Dunbar research consistently show that most investors get worse returns than the very funds they invest in. Think about that. The fund goes up 10% a year, but the average investor in that fund only gets 6%. Why? Because they panic. They sell when things are down. They buy back in when things are up. They do exactly the opposite of what they should do. Here's the frustrating truth. Your instincts are working against you. The same gut reaction that tells you to run from danger is the one screaming sell when the market drops. It's not a character flaw. It's just biology in the wrong context. The crash isn't the problem. Your reaction to the crash is the problem. So how do you actually stay the course when everything in your body is telling you to run? Here's what I've learned. You don't need to become fearless. That's not realistic. You just need a system that removes your panicking brain from the equation. For me, that means automation. My investments happen automatically every month. I don't have to log in and hit buy while my portfolio is bleeding red. The money moves on its own. Buying more shares whether the market is up, down, or sideways. When you automate, you take your emotions out of the equation. The money moves before you can talk yourself out of it. And I've stopped checking as often. During volatile times, I might not look at my portfolio for weeks. Not because I don't care, but because checking doesn't help. It just feeds the panic monster. The other thing that helps is perspective. Every crash you survive makes the next one easier. I was way more freaked out during my first major downturn than I was during COVID. Not because COVID wasn't scary, it was, but because I'd seen the pattern before. You build what I call investing scar tissue. You learn in your bones, not just your brain, that crashes are temporary, that the math keeps working. The people who've weathered 2008, 2020, and every dip in between have something that can't be bought. Confidence that only comes from experience. They've seen the math work, they felt the fear and stayed anyway. But here's what keeps me up at night. The market always goes up. We've established that. The math is on our side. The self-cleansing mechanism keeps working decade after decade. So here's the question that should bother you. If the market always goes up, why do most investors actually lose money? I'm not exaggerating. The majority of people who invest in stocks end up worse than if they just bought an index fund and literally never touch it again. Even when their fund makes money, they lose money. How is that even possible? Turns out we're psychologically hardwired to do exactly the wrong thing at exactly the wrong time. There's a pattern that almost everyone falls into, and most people don't even realize they're doing it. Someone once described it to me like this: the stock market is like a glass of beer. There's the actual beer, that's the real wealth. And then there's the foam on top. That's the volatility, the day-to-day ups and downs. Most investors spend their entire lives trading the foam, trying to time when to get in and get out, and they completely miss the beer underneath. In the next video, I'm breaking down exactly why most people lose money in the market, the psychology traps that catch almost everyone, and the simple fix that changed everything for me. Click here to watch it now.